Hi, I'm Steve Brown. I'm the CEO of Fortress Real Estate Investments, and we've recently released our interim results for our financial year ending 30 June 2026. So this is our first half of the financial year, and it's been a remarkable 6 months. I think more so than anything, what we've seen in the market is the return of a lot of capital into the real estate sector, and that's been evident in the share prices in not only ourselves in Fortress, but also in our peer group. And I think it's a welcome relief from where we were a couple of years ago to see capital returning to the real estate sector. And I think initially what usually happens is public markets lead private markets. So we also are seeing now a return of a lot of the private buyers and investors. So our sales are now looking a lot more buoyant, and the prices we're getting offered have certainly increased. And I think it's really driven by a healthy real estate market in South Africa at the moment. We have two core portfolios, one being logistics and the other one being retail, which is really focused on commuter and transport retail. And the pleasing performance in the last 6 months, we've seen the logistics like-for-like NOI growth of 6% and retail's grown 7%. So I think that's really been great performance, especially in an environment when inflation's quite low at around about 3.5%. So that's buoyed the market, and I think the public investors and our shareholders have noticed that and started to buy the shares, and there's been a lot more capital flowing into the public markets. And to a lesser degree, but also what we're seeing is a lot more green shoots from direct real estate investors who are looking to buy our non-core assets. We've actually taken a bit of a conscious decision at the moment just to hold off on the sales of the non-core assets, just to see where the prices start to settle, because we're seeing a lot more interest in especially our older industrial assets, and even, and a lot more pleasingly, in our office assets, which has had a lot of tough times lately and a lot of headwinds in that office market, but we really have seen that bottom and starting to perform. But when we look at our core portfolio performance in logistics and retail for the last 6 months, our logistics vacancy is amazingly low. It's 0.3%, which is practically nothing. So that's in an environment when we've added a lot of developments, we've added some spec developments. So I think that speaks volumes to the confidence of our tenants in the businesses and their ability to commit to new space. And also in the retail, we've seen the turnover growth of our tenants at about 4.6% for the period, which is also quite nicely above inflation of 3.5%. That is slightly below our like-for-like turnover growth, and really what's driving that is a lot more cost efficiency and the benefits of our solar photovoltaic program, which is lowering the energy costs, not for our tenants, but for ourselves. And we're benefiting from really going green on our buildings and our assets. So our core focus, it remains our logistics and the development pipeline, and focus on really expanding, enhancing and refurbing our core retail assets. The development pipeline is also looking very pleasing at the moment. We've got about 500,000 square meters of GLA that we can add. Most of that is in South Africa. About 300,000 at the moment is in South Africa, focused around the core node on the R21 near the OR Tambo Airport, which has really become the logistics hub of the whole country. And then also we have just over 200,000 squares in Poland and Romania, in Central and Eastern Europe, which has been a great market for us. It's where our largest investment is in the form of Nepi Rock Castle. So it's a market that we've become very used to, and I think we still are very optimistic about the growth in that part of the world. Pleasingly, our largest investment in Nepi Rock Castle, we have about 15 billion rand there, released results recently, and I think their performance has yet again been stellar. They've got a very, very conservative balance sheet. They grew their earnings, which is euro-based, at just over 3%, so slightly ahead of their guidance, and are guiding to another 3% growth for the coming financial year. And I think, 8.2 billion euro portfolio, the third largest listed retail real estate player in Europe, is really quite something from a South African capital base. They've managed to really become one of the stars in European retail, and I think they have great growth plans going forward, not only in their shopping centres but also in their green energy business, which I think is great to see that they're starting to do greenfields photovoltaic sites and sell that energy on a very profitable, scalable basis to their tenants. So all in all, we've had a really good 6 months. Our CFO, Ian Forster, will take you through some of our financials and the upgrade that we've made to our guidance, but it's really been driven off a much better performance from our core portfolio. So I think at the moment, as we sit here, things are looking very optimistic in our real estate space and in our core markets.
So we are exceptionally pleased with the first half earnings for the 2026 financial year at Fortress Real Estate Investments Limited. Our distributable earnings has grown by 16.8% year on year, and the dividend per share for shareholders by 15.4%. This growth has primarily been driven by operational efficiencies and growth in the NOI delivered by the portfolio, as well as some benefit coming from interest rate cuts that we've seen in South Africa and a better funding mix between our European business and our South African business. From a balance sheet perspective, the LTV has come down, reduced by approximately a percentage point, largely driven by the gains that we've seen in the value of our Nepi Rockcastle investment, which we are exceptionally happy with at 31 December. The dividend that we have offered shareholders for the 6-month period, we've given shareholders an option between a cash dividend of just under 88 cents or a scrip alternative at a 3% discount on a price to be determined shortly after our results have been released. We're very comfortable with this option at this stage, given that the share price of Fortress is now trading at or about our reported net asset value of just under 26 Rand or 25 Rand and 70 cents. We have been able to revise our guidance for the full year to 2.15 billion Rand, which would represent approximately 10% growth year on year in the distributable earnings, which we think is fantastic. Not built into that guidance would be further interest rate cuts should they materialize in the second half of 26, leaving some upside for shareholders on the table.
I think part of the step change that we've seen in the last 6 months, and a lot of the tailwinds certainly in our bond market, and then that spills over into the real estate market, has been the Reserve Bank's lowering of their inflation target down to a set point of 3%. And I think that's really been such a welcome change for us as real estate players, because I think that we've had these very high real interest rates for a long time, and I think that crowds out the investment in interest rate sensitive markets like real estate. With that lowering of the interest benchmark by the Reserve Bank, we've seen the bond yields also come down, and I think that's renewed the interest in certainly our non-core assets, and a lot of the private buyers coming back into the market. So the capital markets have been very buoyant with the inflation rates coming down, and I see many of the economists are forecasting additional rate cuts for the coming year, which is just going to add more optimism into our sector, and I think it's a very, very welcome relief for us. We are waiting for the private markets to catch up in terms of pricing, so we're being a little cautious on selling our non-core portfolio, and we still have this rather large development pipeline to fund. But I think overall, with a lot more capital in the sector, we are very comfortable with that strategy.